I'm Dan Fitzpatrick, stockmarketmentor.com, and it's January 11th. That is Monday, and this is my latest edition of the 3 Stocks I Saw on TV series, where I'm talking about 3 topical stocks that are in the news that we want to look at for various reasons so we can make some money here, okay? Or avoid losing money in Under Armour's case. So today we're going to look at this. Look, the stock's down huge, about 8% right now, like almost 8%. The reason, because Morgan Stanley downgraded the stock with a price target of 62. Okay, from like 103, you know, they always, not just Morgan Stanley, but basically any of these analysts, they're always moving in the wrong direction. But here, so they're out ahead of the stock and the trend. The trend has been moving down for a while. Fundamentals have been lagging for a while. The deal here is that they're losing market share. That is a fundamental, that's a fundamental bit of news. The stock has actually been forecasting that. I mean, you could say, oh, from the high here at 105. But look, it's been right to buy the stock. Here's 200-day moving average, 40-week moving average, same thing. It's been right to buy the stock at the 40-week moving average for quite a while. So if you were still doing that, you know, that's okay. You don't get any demerits for that. But once the stock started to drift below the 200-day moving average, you know that the stock is not under accumulation like it once was. Now, could this be a bottom? You know, typically, like I said, the analysts are always late. Either that or they're early by years. So finally they downgrade the stock, and you can see what happens to the stock. It's just absolutely taking it in the shorts. But here's the deal. I don't care about the price target, $62, because they're wrong on the upside as well, so who cares? What I care about is, technically, I don't want to be long this stock until it gets back above today's intraday high, and that's 72.41, because then at least you can make the case that the stock is you know, closing the gap, it's filling the gap. But just stop and think about it for a minute. This stock has a lot further that it can fall. It was moving up because it was gaining market share here. Okay, about a year ago, early 2015, the stock was even lower than it is right now. So it is not beyond the realm of reason to think that the stock can at least make a round trip down to the 65 level. The stock is in free fall. There's always going to be bounces. There's always going to be oversold bounces. But this is one I would say, you know what, why don't you just take a pass on it? Just take a pass on it. Hey, buy Nike if you have to. Me, I wouldn't even be buying Nike now. Even though the stock's above the 200-day moving average, guess what? Same news, just kind of a different signal. Here, you've got the 50-day moving average. Forming support, accelerates to the upside. Looks like a crescendo top to me. The exit really is about 62 here, which isn't too far above where this is now. Bottom line is this. You don't really want to be in Nike, and you absolutely, definitely don't want to be in Under Armour. Now, that was just a freebie. We're going to look at Amazon and Nike. Amazon, turns out they won a Golden Globe Award. And what happened to the stock? Well, it went up $2. I mean, that's basically it. Look, Mozart, what is it? Mozart in the Jungle. It's supposed to be a great series. I would look at this and it's like Yogi Bear in the bullpen here. The stock has broken down below this support. You want to stay away from this. Yes, it's still above the 200-day moving average, but this here, these are a lot of red bars right in a row, and they're mostly above average volume. This is not institutional buying right now. This is institutional selling. I don't think it's too late to get out of Amazon. Now, Netflix, this is a super choppy chart. There's, on a short-term basis, hey, pick them. It's going to be higher. What's our current price? 113. Here's my prediction. It's going to go to 115. Oh, here's another prediction. It's going to go to 110. Oh, here's another prediction. Both of my predictions are going to be correct in the next couple days. Bottom line is, this is a stock that's churning around. But if you really look at it, you know, I can't say the uptrend is intact. It's been chopping around for over half a year. But I can't say the stock's moving lower either because, yes, it hit a high here, higher high, but now it's just chopping around. It's not printing lower highs and lower lows. It's just chopping around in support here, or in congestion, I should say. So here's the thing. I think you just avoid Netflix. And listen to me because I'm giving you pearls. If this stock starts trading below $100, and if it starts trading below the 200-day moving average, you want to get out of this stock because this would be a big sea change for this stock. As long as it's up here, you can either be long or you can be neutral, but I wouldn't want to be very bearish on Netflix. But I am watching because this potential double top could start looking a lot like Apple when it used to have a triple top before it started imploding. Okay, look, that's it for this 3 stocks I saw on TV video. If you like these videos, do me a favor, tweet them out. Stock Twits, Twitter, send them to your friends because these are all free. I'd like to get as many eyeballs as I can on them. I'll see you next time.